All right. Hello, everyone. Thank you so much for being with us today. My name is Ahmed Murtada. I'm a managing partner of 249 Startups. We're an early stage venture capital firm and ecosystem player. And every year we do this summit to celebrate, but also to share experiences, learnings with different people. Um, I'm glad to lead this panel, that you have different people from different perspectives coming in and joining us. We have Duncan advising the Cash Consortium of Sudan, Funda from the UNDP, Khalid from the Islamic Development Bank of Jeddah, and Ahmed Darwish from Palladium. I'll give them the floor as well to introduce themselves. The main purpose of this panel is to discuss different perspectives for fragile contexts in general, Sudan specifically, in a way or another, about how international community development finance institutions able to de-risk investments and de-risk work in such a context. We are building these questions that we'll be discussing into learnings, at least from the point of view of 249 Startup team throughout the year, about implementing programs in Sudan throughout the previous years within the conflict, different learnings, different perspectives, and building from that, try to understand different also solutions and what had been applied in different countries as well to learn, but also even taking questions open for the future to even explore within the upcoming years. So I will start by giving the floor for the panelists to introduce themselves, their background, to put a perspective and context for this conversation and the entities that they represent, and then we will get into the questions. Feel free to put your Q&As on the Q&A section, and at the end we'll be taking some of them before we close in. We can start maybe with Funda, then Khalid, then Duncan and Ahmed.
Thank you, Ahmed. Thank you so much, and good afternoon, everyone. It's a pleasure to be here with you, joining you for this hopefully rich conversation. So my name is Funda Suzer, and I work at UNDP's Global Private Sector Center, which is based in Istanbul, Turkey. And I am leading the SDG Finance and Private Sector Development team. With our team, we design and implement initiatives and projects across different countries and different regions. And the main objective is to mobilize private sector investments and private sector capital for the achievement of the sustainable development goals. I'm happy to be joining our colleagues here for this panel session. Thank you.
Thank you very much, Ahmed. Thank you, colleagues, for joining at this late time. My name is Khalid Ahmed. I'm sort of having a combination of I would say like hats in this panel. I worked previously in the entrepreneurship ecosystem in Sudan before joining the Islamic Development Bank as basically to go into the financing side. Previously, I started a business in Sudan, and then after that, across this journey, I was a researcher studying the political economy of Sudan and the market integration and the community development. So I think I will be giving my insights on the de-risking aspects from these different angles. And basically, it's not institutional views rather than a personal views and basically personal feedback from these different experiences. Thank you very much.
Hello, everyone. Thank you. And pleasure to be here. My name is Duncan Riddell. I work for the Cash Consortium of Sudan, which is a consortium of 20 organizations, INGOs and national NGOs, with a focus on providing multipurpose cash assistance, group cash transfers, and market strengthening in some of the highest needs areas of Sudan. I am the markets advisor. So I work in and with market actors in the areas that we distribute cash and provide GCTs, work with market strengthening, improved coordination with the private sector. Lovely to meet you all.
Assalamu alaikum. Thank you, Ahmed and colleagues. First of all, many thanks for reaching out and inviting me to speak on this panel. Much like Khalid, I also bring a mix of experiences, having spent my entire life in Sudan before the start of the war, and also operated my own business in both marketing, research, QSR, quick service restaurants, and a wide range of businesses. And it was during that time that I actually came in touch with the Challenge Fund for Youth Employment, which is a private sector development program funded by the Dutch Ministry of Foreign Affairs. And I was basically overlooking the Sudan portfolio during my time in Sudan. After the start of the war, I moved here to the Netherlands, where I still overlooked the Sudan portfolio. So I don't want to say the privilege, because it was unfortunate events that brought me here, but I witnessed the transition of how our portfolio, the CFYE, changed and adapted to the situation before the war, how they went from before the war to after the war. So hopefully these learnings can be insightful and beneficial for attendees of this panel. I also overlooked what we call the Scalable Employment Model call, which is unlike the other calls where we work across 11 countries with 135 businesses. This call is also focused on intermediary businesses. So the likes of Acumen, JobTech Alliance, many that have operations in multiple countries working with smaller organizations, but what we would call probably SGBs and SMEs. And I'm happy to be here also to share the wider learnings of the CFYE in terms of the model and the strategy that we've deployed across these countries, and specifically sharing learnings with the panel on Sudan, but also similar areas of conflict that we work in, which include Burkina Faso, Ethiopia, and to some extent Jordan, because of what's happening across the border in Gaza. So hopefully this will be a rich conversation and insightful for everyone attending. Thank you.
Thank you so much. Thank you everyone as well for your introductions and background. Maybe we to start by you, Khalid. Also, just to start by setting the context on different areas. I think from taking the hat from an Islamic Development Bank mission and perspective, how you generally prioritize the investment opportunities in countries of operations in general, and in the ones that are more fragile and in conflict situation. Sudan could be an example, but there is definitely other examples. Would like to understand how the bank, in terms of development, apply financing, structuring financing when it comes to also the Islamic and Sharia point of view, and the wider range into that.
Okay, this is a very big question, Ahmed. So I will start by giving the perspective of the MDB, which a unique MDB. I think the Islamic Development Bank is one of the very few MDBs that has been started working in 1974, and it is the only MDB that is owned by the South. So we, in our shareholders, there's no basically any, I would say, like Western countries. We do have co-financing, joint operation with other multilateral and development donors, but in terms of the governance structure, capital structure, it is the only MDB that is fully owned by the South. And given the sensitivity, basically, and to support and becoming really close to the member countries and the communities in the member countries, all operation of ISDB has been conducted in a Sharia compliant. So basically, and this is, but at the end of the day, the Islamic Development Bank is an MDB. It's basically, you need to ensure your rating so that you can mobilize capital from the capital, you mobilize resources from capital market to basically to go in terms of the scale. And to mobilize capital from the capital market, mobilize resources from the capital market, you need to maintain your rating. And here's the dilemma: going into fragile countries and difficult countries, similar to Yemen, Sudan, Libya, maybe Syria, so on and so forth, that will actually impact your rating. So you will be, as an MDB, going with an MDB business model, you cannot deploy capital at scale in such countries. But at the same time, the whole idea of the ISDB is built on the solidarity aspect. So this is why the Islamic Development Bank opt to support such fragile countries and basically countries that is considered risky countries. It establish its Islamic Solidarity Fund, the ISFD, Islamic Solidarity Fund for Development, which is based on the solidarity principles, but it's utilized one of the very unique solidarity aspect in the Islamic finance, which is waqf, endowment. So the ISFD it's a model with 10 billion capital. The paid-in capital is 3 billion, and this 3 billion is invested, and the return of this basically capital has been utilized to support the fragile countries and basically the risky portfolio for the bank overall. So this is basically it won't impact the rating of the bank. So this is one of the models that the bank is being using to support in fragile countries, and even the country that is suspended from the ordinary capital operation. There's other type of interventions that basically you focus more within the fragility theme. You focus more on, for example, the refugees. So this is why, for example, IDB partnered with the UN agency to establish the GFR, which basically the Islamic Global Refugee Fund with 500 million. The commitment just yesterday we mobilized additional 10 million from the Qatar charity. I think I'm not part of the fund, but I think the overall paid in capital is around 170. So this is built on the endowment structure, waqf structure. This is invested, and the return of this basically will go to support the refugees operations, and this is totally grants. This for ISFD you can use grants. It could be like concessional loans, but this is the refugees is fully grant. And then because to go also to support I would say like more agile type of people on the ground, like NGOs, so on and so forth, we have Tadamun program, which is, I think it's dedicated for the NGOs in member countries. You have call similar to what Ahmed Darwish mentioned. You call for support. It will give seed funding, grant funding for NGOs that work on at the basically supporting fragile situation, so on and so forth. So this is basically how as an MDB you try to continue supporting your fragile countries, but at the same time you maintain your AAA rating that will enable you to mobilize additional resources from the capital market. I hope I answered your question in a good way.
Yes, thank you so much, Khalid. I think that's a fairest impression into that. People are very aware about other development banks, but maybe not fully on what the Islamic Development Bank do. And for a country like Sudan, it's also very relevant and similar ones. Maybe from that, I'll also take a different perspective as well, right? I'll go to Funda, and maybe the question to be from UNDP side. UNDP have been increasingly working in environments where policy frameworks are weak, markets are very fragmented, and the private capital is hesitant because of these conditions. And in conflict affected countries like Sudan, Syria, and other similar ones, what is the UNDP distinct role in preparing these markets for eventual engagement later on by DFIs, private investors? Basically, what the techniques that you implement and how you look into these markets as well.
Thank you, Ahmed. Thank you so much for this question. Yes, as you have mentioned, the private capital is hesitant when it comes to particularly the fragile context. So, and what UNDP has been trying to do and what UNDP's role has been is to help make these markets function enough so that the private sector capital can be convinced to basically deploy funding to the areas where it's most needed. And I mean, unlike the DFIs and the MDBs, we work at the level of market systems rather than the transactions, individual transactions. And in practical terms, that means focusing on the conditions and also creating enabling environment for particularly the SDG aligned and development aligned businesses and investment opportunities. As UNDP, we help prepare markets by strengthening the investment ready pipelines, aligning capital with the SDGs through the impact frameworks, and also we help reduce the policy and institutional risks. And we do this by working across 3 areas: leveraging capital, aligning capital, and strengthening policy and institutions. For the leveraging capital, the starting point is to help close the gap between the private capital and SDG aligned opportunities. And through our work, we focus on providing or building pipelines of SDG aligned investment opportunities and projects across different countries. For instance, we have a tool called SDG Investor Map, and it provides a structured market intelligence on specific investment opportunity areas in different countries. And this is particularly valuable in fragile context because the information and data is weak and not very much available. The information asymmetry is high in those contexts. So the maps actually provide the market intelligence and the country information for the potential financiers in specific countries. We also help for the investment facilitation through our convening role, and we organize investor convenings, bringing together the enterprises and the companies with the potential financiers and investors. On the aligning capital, we help the companies and the projects deliver financial returns and also the positive social and environmental impact alongside the financial return. So we basically help investors and funds and enterprises to apply impact management frameworks. And through this, we also provide capacity building and trainings on the innovative finance instruments as the impact standards or the impact management and management courses. On the policy side, which is one of the main pillars for creating an enabling environment, we work with the governments and institutions to create policy frameworks or to change the policies. And here we have 2 important initiatives: the Integrated National Financing Framework and Insurance and Risk Finance Facility. The Integrated National Financing Framework helps countries systematically map the financing needs and identify the policy bottlenecks. And this actually provides investors with a clear view of government intent, the priority sectors, or the reforms and policy changes that will help reduce the policy uncertainty. And in vulnerable contexts like Sudan, the risks such as climate risk, disasters, or the systemic uncertainty are often uninsurable. So through our insurance facility, for instance, we work with governments and regulators to develop risk financing and insurance solutions. So for DFIs and private investors, these mechanisms are particularly important because they reduce the exposure to certain types of risks. And this is how this is the role that UNDP plays to help bridge the gap between the fragility and the finance by helping the governments to create an enabling environment. Over.
Thank you so much, Funda. I think it's good to understand also from ISDB and UNDP how they look into fragile countries and contexts. Maybe I would switch from that to you, Duncan. and taking a more extreme, different context, coming from a humanitarian perspective. Funda did mention that the lack of data as well into such a context, and traditionally humanitarian had more hands-on into different markets. So maybe looking at one of the activities that the Cash Consortium work on, and from your experience across the years, in general, the cash-based assistant or the cash-based humanitarian assistant have been often described as being market friendly. They help develop markets in different ways because they bring in money going around, and it allow people to, of course, it assists them, but also at the same time it allowed them to use that money, and that money could go into cycle. So maybe from your experiences of working in Sudan across different times, including within the current time we are in and the conflict, how has the cash programming in general reshaped these local markets and the economic behavior per se throughout the previous years since the start of the war in Sudan?
Thanks, Ahmed. So from my perspective, I think there's a tendency to over-attribute change in markets to cash programs alone. From the reporting and data that we get, and from what we're seeing on the ground through our teams, including recently, I just got back this weekend from Tawila in North Darfur. I wouldn't say that like markets have been reshaped by cash distributions in the sense that they have been transformed. What cash has done is it activates demand within market systems that are already operating, and I would say in Sudan, and I'll speak more precisely about Darfur's and the Kordofans, where they're operating under extreme structural constraints. So in these areas, markets remain largely supplied through cross-border trade, corridors from Chad or from South Sudan, and other informal routes. So what we see is that these corridors, they're not marginal. They're the backbones of the markets, and the supply for the populations for food, DFIs, fuels, basic consumer goods. Traders continue to move goods and operate their businesses despite insecurity, multiple taxation points, fluctuating exchange rates, and many other challenges. So I think that tells us something important. The market actors in Sudan are very adaptive, much before cash distributions enters the system or the equation. What cash distributions have done in Sudan is it's increased the purchasing power at a household level. So that temporarily boosts demand. In Tawila, where I was, traders described increased purchase business following the distributions, but from our analysis, it shows that creating the demand does not necessarily equal market strengthening or business improvement, because supply in many of these areas is constrained by factors that are well outside like humanitarian control or overview. We're looking at fragmented authority, import and checkpoint taxation. We're looking at volatility in the pricing. We're looking at different SDG notes being used in different regions. We're seeing a lack of formal financial institutions operating in many of these areas. We've seen a collapsed telecom network, which traders have previously relied on as a main source of information, somewhat replaced by Starlink, but not entirely. So we see that cash works as it's intended, but its impact is dampened, not by the markets failing, but by systemic, what I would say, friction. Traders complain when we talk with them, not the lack of customers, but the liquidity shortages, the transport costs, the currency risks, the taxations that they face, the insecurity. So cash can increase demand, but unless traders can restock, which requires lump sums paid up front, cross-border availability, affordability, it all comes under pressure. So one point I think it's important to make is that cash programming has made markets more visible to humanitarians that met the needs at the household level, but engaging regularly with traders in the private sector through market monitoring, vendor surveys, PDMs, we have a much more clear evidence-based understanding of how markets actually behave under conflict in Sudan, including price formation, supply bottlenecks, and the trader coping strategies that have been used. So this has shifted the conversations away from the assumption that market collapse, about the discussion around market collapse, to the narrative around market adaptation and the constraints which they faced. So affordability, it's not affordability, it's availability of items. Markets in Darfurs and Kordofans are mostly stock, but prices reflect the long and insecure supply chains that they have to follow, cumulative informal taxation points, exchange losses at multiple conversion points. So I would say, in summary, the real lesson in Sudan currently is that cash doesn't operate in a vacuum. It interacts with the trade systems, the informal governance, the market systems in which we work in. So if we want cash to achieve its full potential, we have to understand and design around those realities and not assume that demand alone will support those markets.
Thank you so much, Duncan. That's indeed a different perspective, right? When looking into really the extreme fragility, and yes, on one side, the humanitarian does work and provide cash and increase application power a bit for people, but also the market not necessary for. Maybe from here, I would jump to Ahmed Darwish, and basically Palladium and program like Challenge Fund for Youth Employment across the continent, in Africa, but also in MENA region and other places. It does play that place in between donors, impact investors, implementing partners and companies. So they technically absorb some of the risk in between. Maybe my question to you on this, and building on all previous points, in such a similar context like this, and maybe from implementing a technical assistant perspective, what risk do the donors and the impact investor you do work with often underestimate, maybe when they look into such a markets like Jordan, like Sudan, like Palestine, like others? And on the other side, what are the risks as well that the investors, the private investor, local investor, tend to overestimate in these conflict affected markets? Because you see the both sides, you see the upside and you see the other side as well.
Thank you, Ahmed. I think initially it's important to give some context that the Challenge Fund for Youth Employment operates on a matched grant funding approach, so that at its core is already a de-risking mechanism. Essentially, what we do in every call is we would go in, do the scoping, identify basically what criteria will inform, what information will inform the criteria for the call. So what the type of call that we launched in Sudan will not have the same criteria as that where we would launch in Ethiopia, for example, or Jordan, Kenya, or what have you. So based on that, we identify information such as minimum wage, high employing sectors, the youth, since this is actually our main target, what are the youth interested in? And that basically informs the criteria for the call. For Sudan, not only was there a lack of information before the start of the war, but it was already a very risky environment to invest in, let alone after the start of the war. So what we were looking at was the right partners, choosing the right businesses to work with, businesses that will take into account the importance of youth employment for their business. You look at things and generate learnings and spread also, disseminate learnings from other markets and other calls and other countries on the business case for youth employment itself. That is to give incentive for the businesses to hire youth, and that altogether should push for a business that looks at youth employment not only as a target, but as an outcome that is kind of integrated within the call, because it is, at the end of the day, a payment by results model. So for each business, they need to achieve certain milestones to be able to qualify for certain payments. And in the end, it's a one-to-one investment. That is just to paint a picture of how we operate, taking into account or focusing and zooming in more on the Sudan situation, and from a technical assistance perspective as well. because we do provide grant funding, but also technical assistance. Initially, the technical assistance is looked at as a portfolio-wide, from a portfolio-wide lens. So what are all the implementing partners or the businesses that we're supporting facing as challenges as a portfolio, as a country? And then we would zoom in even more at each business and discuss and analyze in partnership with these implementing partners what are their specific challenges and what type of technical assistance can we customize to help address that. When it comes to underestimating and overestimating, I think maybe starting with overestimating is the fact that people immediately assume that fragile context means no business, no revenue, everyone's leaving, and why would we even go there? I think underestimating is then coupled with that, with the fact that, okay, there are some businesses operating. However, how are they operating? And Ahmed, you know that based on first-hand experience. Things as simple as, and Duncan can maybe also emphasize on that, but this is from maybe the business perspective. Receiving money alone is a huge challenge. How do we go about these restrictions that these businesses are facing? Because before we speak about the end beneficiaries, how are the employers receiving these funds to be able to distribute to their employees and essentially have that ripple effect down the chain to the final beneficiaries? I think these are things that there is no one answer that basically resolves it. But through working with these companies, through understanding context, and that brings me to my other point, is what I find that was very useful with the Challenge Fund for Youth Employment was the local experts and taking into context, empowering not only the teams that are representing CFYE in country to shed light on the local context on how things work, but also the trust and relationship that you have with your implementing partners. I think this played a huge role in us working with our own implementing partners on redesigning their projects after the war, being flexible, being understanding to what they're going through, and without the local expert kind of giving that stamp of approval on, yes, the implementing partners are saying the truth, they are right about this, this is very difficult to do. I think without that, you're just basically trying to command from across the borders without really realizing how things are on the ground. I hope that answers your question.
Yes, thank you, Ahmed. That's a good also perspective as well from in the middle. Maybe from that I will go this time back to Funda and maybe asking a question also from a practice point of view and the different deployment that the UNDP and also building your previous answer have been taking. What are these de-risking tools? Maybe to explain that, what are these de-risking tools that similar and such organization have used and have been proven to be most effective in such a markets, from first loss capital guarantees and etc. And where do they typically fall short, and they also might not be resulting in the result that everyone have been looking for, from your own perspective and experience?
Thank you, Ahmed. For fragile and conflict-affected markets, for de-risking to work effectively, it's important to design a matching tool for the type of risk that we are trying to address. So, for instance, early on, the risks are operational and execution related rather than purely financial. So, in that phase, concessional or first loss capital can be very effective because they absorb the volatility that enterprises simply cannot manage on their own. And this kind of capital creates spaces for companies to keep operating. And technical assistance is also another critical de-risking tool. And it's particularly important to link it to the real business constraints, of course, like, for instance, cash flow management, supply chain adaptation, or compliance with basic standards. So the technical assistance can also work very effectively as a de-risking tool. And as markets begin to stabilize, the matching mechanisms and co-investment structures can help crowd in additional capital, particularly from local and regional investors. And another de-risking tool could be credit guarantees. The credit guarantees can also be powerful instruments. But for that, the banks should start lending. So the contracts should be enforceable and companies should have predictable cash flow. So the credit guarantees can be considered in the later phases. And so the key lesson is actually not about choosing the right instrument in absolute terms. So it's about having a phased approach. So the de-risking works when tools evolve with the market. So moving from risk absorption to risk sharing and to risk transfer. And for these tools, I can give a couple of examples maybe. For the first loss capital, concessional first loss capital, I can give the example of the Build Fund for MSMEs in the least developed countries. And UNDP usually works collaboratively with UNCDF for designing and deploying these de-risking tools, particularly in the LDCs. And the Build Fund is one of those examples. The donors and the partners have committed over $55 million. And it includes a junior first loss tranche funded by the donors to absorb the initial losses, and also it has a guarantee layer. And another example regarding the credit guarantees, for instance, in Afghanistan. So we again collaborated with UNCDF and implemented a portfolio credit guarantee. So again, the UNCDF, through its funding from the donors, it provided a $1 million counter guarantee to support the Afghan Credit Guarantee Foundation. And this guarantee actually was able to unlock an outstanding loan portfolio of more than $9 million. So achieving a leverage of 9 for the loans provided to the MSMEs.
Thank you so much, Funda. We'll take also another round of questions with Khalid, Duncan, and Ahmed, and then we will open question for the audience. So feel free as well to put it on the Q&A section. Maybe coming to you, Khalid, based on similar point, how does the bank and Islamic Development Bank work with these private investors and these local funds in similar countries, or even the venture platform that work with businesses to share that risk basically, without also crowding out the commercial participation from the existing player, and not to spoil the market basically with quite a lot of capital. So I'd love to hear your perspective.
Thank you, Ahmed. And I would just start by having some sort of like a global perspective. Why de-risking? I remember in 2017 when we start working internally on the SDGs community of practice, the statistics was that to achieve the SDGs, you need 2.3 trillion per year. And the last time I checked, I think that was 1 month ago, the amount that is needed to achieve the SDGs by 2030 is 4.4 trillion. Okay. All the development finance, from the official development assistance from the Western countries, the MDB, so on and so forth, all funding is around 195 billion. So the whole idea is that you cannot achieve the SDGs without bringing the private sector. And this is the whole movement, which is from billions to trillions, is based on this de-risking mechanism. How you can use this development financing, concessional financing to basically unlock the private sector, to de-risk the private sector contribution, so on and so forth, because you cannot achieve the SDGs, globally speaking, and this, of course, in a fragile countries actually make more sense. So from the Islamic finance, from the Islamic Development Bank perspective, so on and so forth, the question is how you could create a de-risk mechanism that is Sharia compliant. And I mean, as a Sudanese, especially as a Sudanese, we should be able to bring more insights on this, because the main scholar who opened the doors for such discussions, he was a Sudanese, Sheikh al-Darir, basically, when he wrote about the gharar, and basically how the Islamic insurance and Islamic guarantee is different from the traditional guarantee, this was basically a very gray area until he wrote his book Al-Gharar, and basically that opened the whole market of insurance and guarantee. And I would give 3 examples, very practical examples, one from Sudan, one from Morocco, and one from Suriname. So for Sudan, which basically this is not basically initiated by IDB, but IDB worked with the government on this. In 2010, there was a very innovative proposal to use the zakat money to establish what is called Sanduq al-Aman al-Ijtima'i, basically the fund for social security. So they used the zakat money, and that was under Sabir Mohammed al-Hassan, as well as the other commercial banks. So they used the zakat money to create an Islamic guarantee, okay, that will provide some sort of a backup for the commercial banks to extend their funding for micro enterprises and for MSMEs. And that was I came across to know this very, very interesting model when I was studying the case of Wad al-Ballal, Qaryat Wad al-Ballal, which is a very unique model that has been recognized in 2015 as and they won the Reuters and Islamic Abu Dhabi Bank for the best ethical financing project all over the world. So this is a very interesting model, okay? Basically, because you talk about fairness, loss protection, so on and so forth, but when you go on the country like Sudan or other Muslim countries, okay, how I can do it in a Sharia compliant way. So that was a very interesting model, and there were a lot of discussion on how, basically you could use the zakat money not directly for a faqir and miskin, which basically the 8 categories to use the zakat, but to facilitate supporting for them, to facilitate the financing and the support for them. So I think that was the first case. The second case in Morocco. So in Morocco, which is like a middle income country, there was there's a state institutions for guaranteeing the loans for MSMEs, which is called Tamwilcom. But the issue is that was based on a traditional financing. And Morocco was a very interesting model because more than or around 40% of the MSMEs, they explicitly mentioned that we want some sort of Islamic guarantee, but we don't have it, okay? And because there is no guarantee, the commercial banks, the contribution of the Islamic banks or the bank with Islamic windows is financing less than 10% of the MSMEs. So what happened was just one technical assistant, just small grant, even less than 1 million. So IDB worked with Tamilcom to open and is basically a branch that is based on the takaful, because basically the difference between the traditional, the conventional guarantee and the Islamic guarantee is basically you create mutual credit pool to and there's some sort of like a takaful or solidarity in this aspect. So the IDB supported in building that window, okay, and then all of a sudden the contribution, the financing of the the bank with Islamic windows or the Islamic banks shoot it up in supporting the MSME. So sometimes you just need to tell the country how to do this, how they can de-risk some sort of, like for most of the part, I think the the development institutions and even the finance institutions, they think that their main value addition is just to give money. But then, considering the brain drain movement, the huge brain drain movement in developing countries, sometimes you just tell them, you work with them, you sit down with them, and you tell them how to do it. The third example is in Suriname, which is basically a country in Latin America, but it's still under our member countries, 57 member countries. We were partnering with, I think, with FAO and UNIDO on supporting the smallholder farmers producing pineapple and exporting that pineapple to basically to I think to Netherlands. I think Netherlands is one of the main directions for very good for Suriname pineapple. And the whole operation was basically, and I remember that the pocket of the money that we had was very small. And even the other pocket of the money for the colleagues in FAO and UNIDO were very small. So we were focusing more on the technical assistance, supporting them, the certificates, so on and so forth. But they were a big dilemma, basically. Who will ensure those smallholder farmers financing? They don't have collateral, they don't have land. And sometimes you think that by just doing technical assistance, you will support them, which is not the case, basically. You need to have the three package together, the financing, technical assistance, and the access to market. So we come again, we work with one of the banks over there. We establish a guarantee facility for the banks. And I think the leverage ratio was 1 to X. So with 300,000, we managed to get 3 million financing for those smallholder farmers. So I think the de-risking, it should be different from country to country, but I think the main principle here is you listen to the local communities, you work it out with the government and with the partner. So that would be my answer. Thank you.
Thank you, Khaled. Very great examples, and I think everyone could look into them in these countries you mentioned, because these are actually cases that maybe we could even adapt and explore even more for Sudan. I would take similar point of view from, there is on one side donors, international community, the risking and money coming in. Maybe let's explore that from humanitarian point of view, Duncan, and developmental point of view, and business point of view with Ahmed. So maybe Duncan on this point, but from a different perspective. Where do you see that? Where do you see that the humanitarian interventions, pumping money, cash programs, and etc., unintentionally crowding out markets and spoiling markets, and where do you or where do they actively enable future private sector engagement from a perspective of sustainability even beyond the current gap of humanitarian assistance, and do you see them working together as well, humanitarian and the private sector?
Thanks. I would say that that crowding out of markets in Sudan is rarely intentional. When it happens, it's usually a result of design choices that are made under pressure, rather than deliberate decisions to bypass the local markets. One in the humanitarian area, one clear risk we see is like large scale or poorly sequenced in-kind assistance in areas where markets are still functioning. Even when motivated by access or speed, in-kind distributions can temporarily depress prices, reduce trader turnover, and discourage restocking. So particularly for food and basic household items. So when we talk with traders in Darfur and the Kordofans, they consistently have described how sudden in-kind arrivals can create uncertainty for them. They hold back on restocking, they reduce variety, or exit certain product areas altogether. So in already fragile markets, that can push marginal traders out, narrow supply diversity over time. So another crowding out risk comes from maybe around short-termism and a lack of predictability. So one-off cash injections without attention to how traders finance restocking or managing currency exposure, or can unintentionally create volatility. So demand spikes, but supply cannot respond fast enough because the traders face their own liquidity constraints, transport delays, or exchange losses. So when that happens repeatedly, markets are not strengthened, they can be under stress. So I think a third less visible risk is fragmentation across agencies. So when different actors apply different criterias, pricing expectations, or engagement rules in the same markets, traders can adapt strategically, sometimes prioritizing humanitarian linked sales over wider community supply. That doesn't show up immediately in monitoring, but it can distort the incentives and weaken the market's broader roles. So where humanitarian interventions, I think, can enable future private sector engagement is when they treat market actors as part of the system, so not just as delivery channels. So in several Darfur locations, including Tooele, working through local chamber of commerces, working around dialogue on pricing behavior, expectations around restocking, help stabilize availability even during and after distributions. That kind of engagement can build trust. It can preserve institutional memory, and that matters a lot more in very vulnerable or fragile contexts. So another enabling factor is respecting how markets actually function under conflict. When humanitarians acknowledge constraints like the checkpoint, taxation, dual currency, telecom blackouts, informal financing, rather than designing around an idealized assumptions, I think the traders respond more responsibly. They price more cautiously, they maintain stock variety where possible, and can serve all different populations. So ultimately what enables future engagement, I don't think is like sophistication or innovation. It's like predictability, coherence, trust. When market actors see humanitarian programs that are consistent, coordinated with them, and grounded in the reality that everyone lives in there, they continue investing their own capital and effort despite the risks that they face. So that's the foundation of, I think, any future private sector engagement, humanitarian, that would want to build.
No, thank you for that, Duncan. From here, we'll move to Ahmed, and then we'll take questions from the audience. So maybe on a similar point of view, but different perspective, Ahmed. So you see many donor-supported SMEs, specifically within similar contexts as well. They usually struggle to survive these shocks when donors funding cutting, or where the markets, for example, depending on that, you're another supplying to donor funded markets or humanitarian funded markets or something like that. So if suddenly there was a donor very active and then suddenly moved out because of change of political or on ground on country, so that's a shock. A couple of SMEs does not survive that shock if they are heavily dependent on that. So what are the operational or governance or even financial design choices that you have seen that it help improve the business continuity during period of disruption that could possibly absorb that shocks if it did happen in the future? Well, possible, of course.
Yeah. It's, again, a very difficult one to answer but it goes back to, I would say, choosing the right partners to start with, partners that have the capacity to absorb these shocks, the ability to diversify their revenue streams and adapt to such occurrences, not only when donors step out, but also for other external factors that may affect them. So I would say it, again, goes back to having a robust mechanism when selecting the partners you want to work with, when supporting them with the appropriate TA that helps them become more agile in terms of how they react to market changes. And from the donor side, flexibility to see and understand and adapt to local context changes. It has to have an element of strong local leadership and governance. As Khalid said as well, and he alluded to, you have to really sit within the country context, understand all the different moving pieces, and not just judge and govern from afar. Technical assistance has to also be customized, because the same type of technical assistance, for example, delivered by someone with local expertise might far outweigh a scholar with many more years of experience who doesn't have that local context, logically so. So I would say it's very important to take these into consideration when originally formulating these type of programs to operate in these fragile contexts, but also to have a sort of learning loop that keeps on generating insights from these countries. I think an interesting one we had in the Challenge Fund and 249, where we're one of the respondents in this research, we had research on youth and women employment in fragile contexts, where we looked at employers, but also policymakers operating in Ethiopia, Burkina Faso, Sudan, and Jordan, and looked at what models are being adopted in these countries to, one, operate in a fragile context, but address issues such as brain drain, such as retention, such as the many issues that come with this conflict-related fragility, and then look at what model is being done, what is interesting that's happening in Ethiopia that can be taken to Sudan, adapted to the context and deployed there, and vice versa across the four countries. So that's one other thing to consider. Another thing I would also look at is when you're developing that portfolio in a country you're entering that has this fragile context situation happening, is to look at players that bring something different that can improve the entire infrastructure in some sense. You can choose, for example, one that addresses agri, but then one that has a fintech element to it, and then one that is training, and that's an intermediary. I think for us, it just so happened that by chance, and this was before the war, when the portfolio was selected, we did look at different players in different markets. For our sake, that was a de-risking mechanism in the sense that Sudan was an unknown economy, it's an unknown market. Challenge funds were very new to Sudan. Let's choose implementing partners from different industries. That way, we protect the portfolio as a whole. But in the long run, we saw, for example, one implementing partner that had to drop out, that came back and reconnected with one of the implementing partners that is still active. And that way, you have sort of a co-creation value happening across the portfolio. So this, I would say, is the learnings that we have on our end. And one more thing I would add is, but this again depends on the length of the program. This learning loop helps a lot in seeing how you can improve, because one technical assistance might not work, but if you don't have the learning loop of why didn't it work, you won't be able to implement an improved one in the future, whether it's in the same country or in a similar country. So once again, I would say just keep this learning going, deploy it within the program, but also try to share with the wider ecosystem and see what you get out of it as well. Maybe one model I would also allude to is patient capital model. I've seen this with one of our implementing partners, Acumen in particular, and that has, I think, proven to really produce great results, because what is impact investing in, especially in fragile contexts, if you end up holding these implementing partners accountable for very strict targets in a very stringent manner. So patient capital in any context, but specifically in fragile context, flexibility to allow changes throughout the program. Again, it depends on the size, the scale of the program. In our case for Sudan, and due to other elements of luck maybe, we've had implementing partners allowed to operate in other countries. So although the program was targeting Sudan, we had our implementing partners move to other countries, achieve their program targets there, and then we would count their targets there. So on our end, we provided them the flexibility of time, that's one, but also two, the ability to redesign their program in a different context and still allow them to count these targets, and therefore they would hit these grant funding once they've achieved these milestones. I think that's it from my end, and I hope this was clear. One thing, Ahmed, I'm not sure I have access to the chat for the entire participants audience. So I'll just drop the link of the research we had on this in the panelists chat window. Please, if you have access to the participants, you can maybe copy and paste it there. Thank you.
Yes, thank you. I did put the link now to everyone. I would like to thank all the panelists, but maybe before we close, we can take a question of two from the ones on the Q&A. So there's this question from Abdullah. He's asking, what is the potential for insurance companies to be part of the solution in securing the ongoing business? Maybe this is something Funda or Khalid you'd like to respond on it. What is the role you see for insurance companies in basically being part of that process of de-risking in a way or another?
So I think I will quickly take this. I think there's we can talk about what do you call it? We can talk about more like a macro level, and we can talk about like more micro level. I think for Sudan, and I think we have discussed this before, Ahmed, I think there's a necessity to have a development planning institutions, being, basically a dedicated national bank for development bank for Sudan, or basically being a committee or whatever you call it. But there's a necessity to have such type of, I would say, the pillars that will make any development, basically humanitarian, peace, development, nexus type of interventions. And for such things to happen, they especially when they want to operate in the local market, when they want to incentivize the local market to respond to they want to engage the what do you call it, the financial institutions, the banks to put money. I think there's a necessity to engage the guarantee type of facility. I know there is a difference between insurance and guarantee, but basically it's more about de-risking. But the insurance is different from guarantee. But I think they can play this role really. But there's a necessity to have a government act here. Without such type of move from the government to coordinate things, I think all the initiative of the insurance or the guarantee companies will just be fragmented, and it will not serve the country at an impact level or at a bigger scale. So that's my what came to my mind in addressing this question.
Okay, thank you.
Yeah.
Yes, go ahead, Funda.
Yes, I mean agree with Khalid that there should be a government involved in taking a role in the design of any mechanism with insurance. The insurance companies can actually play a very instrumental role in terms of course, not eliminating the risk as a whole, but making the risk more manageable. And at UNDP, through our insurance and risk finance facility, we have been supporting the governments for development of specific insurance solutions in different countries. In Bangladesh, for instance, we work with the government to develop the micro insurance and agricultural insurance products. And in Jordan, we have contributed to development of the inclusive insurance solutions linked to refugees and host communities. So there are potential solutions, mechanisms where the insurance companies can play role in terms of addressing the challenges. But of course, we need an authority to work with.
Thank you so much. We'll be taking one last question before closing up. There's a question from Qasir Rafiq. He's asking, maybe this is for you, Duncan. He's asking about how do you see the current status of humanitarian and private sector partnership in Sudan? Any insight on that?
Thanks. How do I see it? I see it as like a area that's constantly improving, and that there is a growing recognition of the markets as the main lifeline to most of the populations in the most high need areas. So I think the organization, especially humanitarian organizations, are starting to recognize and work with these market infrastructure and not design around them. I see that as definitely a work in progress. There's areas to fix. And however, there's other space that like humanitarians are slowly understanding also that they don't have a space to work in, and that's around like monetary policy and these areas that are outside of their remit and focus. I see that humanitarian actors are also avoiding more design choices that punish functioning markets, more cash, more investment in the private sector. Mostly this is at the local level. I think there's more questions around in kind and why not cash. And I think also an important thing that's working is changing the narrative a little bit. So I think humanitarian organizations are pushing back on this narrative that markets in Sudan, especially in the areas of conflict, are on the verge of collapse. I think there's a reframing. They're functioning, but they're constrained. We can design differently. And that narrative choice influences not just the current programs, but how donors, partners, the private sector, and future actors think of what's possible in Sudan. But I think it's a constantly evolving landscape.
All right. Thank you so much, Duncan. Thank you as well for, yes, Ahmed. Go ahead.
Thank you.
Go ahead, go to that.
It's just something I wanted to maybe take advantage of this platform and your audience to share, is to highlight the fact that for the longest time, Sudan's private sector has been operating fully at their own risk. And the biggest losers were the ones who do not have the collateral and do not have the means to take any sort of support to de-risk their investments. Now, obviously, the situation has went to even way more drastic extent that even the larger businesses who could previously afford are now in very, very deep struggles to maintain a business to keep continuing. And what is a country and its functionality without there being a private sector that employs the people and provide the means? And I think it's important to highlight that now more than ever, Sudan needs donors to be present, to choose wisely, to not have prejudice, and also to trust the local expertise that they reach out to help identify the right partners who will address key components of the country's infrastructure, prioritize based on urgency, based on emergency, and look at things that make sense. Do not make the life of implementing partners harder by complicating routes for financing, by complicating validation, by complicating due diligence. This really has to be looked at differently. And I'm hoping that people will finally see that private sector has been holding intact Sudan for so many years, but now more than ever, without the support, tragedy that is unfolding is only going to get worse. So just once again, thank you, Ahmed, for providing this platform for us to share our insights and to hopefully send our voice out to everyone to keep eyes on Sudan, as we keep saying, to keep supporting Sudanese people all over the world. Thank you.
Thank you so much, Ahmed. Khalid had to drop. But thank you as well for Khalid, Funda, Duncan, and everyone. Also, I'd like to thank everyone with us today. This is just a start of a series of a couple different topics. All these topics will be published later on in small papers, and we'll be taking some actions on it to build on for the next year. There is another one later on today and tomorrow. Thank you again, and thanks again for all the panelists for being with us and for the great insights.
Thank you. Assalamu alaikum. Shukran.
Thank you so much. Thanks.